single day. I'm gonna make something great. That's my way.
Hello everyone, and welcome back to my channel. I am Ginger Wolf, and this is Stripped Finance. I am a feature entertainer and stripper, not a financial consultant. So any and all information received from this channel is meant only for educational, informational, and entertainment purposes. So please, if you have any questions or concerns, take it up with your financial consultant. Now with that out of the way, let's enjoy today's video. Bye!
Hello everyone, welcome back to Stripped Finance. Sorry, my brain kind of like froze there for a second. Anywhoosie, so today we are going to be doing a double feature. We're going to be doing a Graveyard Market and the Cockroach Theory. Because although both of these are really cool topics, the articles that I found on them are kind of small. So, today we're going to be doing an Investopedia article on a graveyard market. The article is by Will Kenton, reviewed by Chip Stapleton, and fact-checked by Katrina Municello. What is a graveyard market? A graveyard market is one in which bearish sentiment persists, causing existing investors to sell and new investors to stay on the sidelines. Existing investors do not want to acknowledge their large, unrealized losses, and as a result, they may not even look at their brokerage statements. At the same time, new investors remain fearful of future market declines and are reluctant to buy. Even at lower prices for both groups, the market appears dead or in a zombie-like state. Breaking down the graveyard market. A graveyard market reflects huge declines in the market over many months, if not years. Risk aversion is the dominant theme, even though valuation multiples may be low by historical standards. For example, the S&P 500 dropped by 56.8% over the course of 517 days during the bear market of 2007 to 2009. Current, forward, and even 10-year-old or Cape stock multiples all fell precipitously, but buyers still remained reluctant until March of 2009. Even then, many who had money to invest refused to re-enter for quite some time. Conversely, Black Monday in 1987 is not a graveyard market, even though it ranks among the very worst declines for a single trading day. In percentage terms, unlike the graveyard market conditions in 2007 to 2009, the 1987 crash did not last very long. Fairly short-lived market declines, as measured by points, also are not graveyard markets. For example, the Dow Jones Industrial Index posted a record decline as measured by index points in February of 2018. This led to many negative news headlines, but not a graveyard market. Some of the worst graveyard markets of all time include the market crash of 1929 that preceded the Great Depression, the tech bubble of the 2000s, and the aforementioned Great Recession of 2007 to 2009. Gauging a graveyard market. There is no single tool for predicting a graveyard market or when it may end. One useful gauge, however, is the CAPE ratio, developed by Yale economics professor Robert Shiller. It also is known as the Shiller PE or PE10 ratio. The CAPE ratio smooths fluctuations in markets that are the result of boom and bust economic cycles. For example, companies tend to have higher earnings during an economic boom. In turn, this inflates their prices and the market's overall value. The result is a low current price to earnings ratio that does not accurately reflect the market value. Similarly, earnings tend to fall amid a slowdown in the economy. This causes an extremely high current to current price to earnings ratio, which also does not accurately reflect market dynamics. The CAPE ratio adjusts for business cycles and uses consumer price index values to adjust for inflationary pressure on earnings. Sorry, guys. If the CAPE ratio trends high, then the market often is in a boom period. Conversely, a CAPE ratio that falls for a considerable time tends to indicate a graveyard market. Lastly, a CAPE ratio that turns higher from an extreme low can help gauge the end of a graveyard market. Alright guys, now we are going to move on to the Cockroach Theory. So, the article is by James Chen, reviewed by Thomas J. Catalano, and fact-checked by Suzanne Wilhog. What is the Cockroach Theory? The Cockroach Theory refers to a market theory that states when a company reveals bad news to the public, many more related negative events may be revealed in the future. Bad news may come in the form of an earnings miss, a lawsuit, or some other unexpected negative event. The term cockroach theory comes from the common belief that seeing one cockroach is usually evidence there are many more. Understanding cockroach theory. The cockroach theory is a non-scientific theory that is predicated on the idea that a company's fortunes are dependent on both external and internal forces and may not just be affected by one piece of bad news. Put simply, when you see one cockroach, there are many more that you can't see right away. After all, one cockroach usually means there are more lying around in the dark. So when a company is negatively affected by external forces, it is unlikely that its industry peers are immune to those same forces. Therefore, when one company's misfortunes are revealed to the public, it is likely that similar misfortunes will befall other similarly affected companies. Earnings surprises or misses are indicators of industry trends, particularly if they occur for more than one company in an industry. If one isolated company in a sector shows an earnings surprise, it could be ignored. However, if more than one company announces an earnings surprise or miss, it could be a strong indicator that other companies in the industry will also have similar results. The effects of a cockroach theory. Bad news is unavoidable and inevitable, regardless of company or industry, but in many cases, a company's upper management team may try to downplay the effects of any bad news. In fact, some try to turn it around by putting a positive spin on the news, even if there's an impact on the company's share price. For some companies, it may be a one-off, but that may not necessarily be the case for others. Wise investors may be able to see through these public relations strategies and understand that a sudden revelation of bad news may lead to something bigger in the future, for the company and even the industry as a whole. The cockroach theory can have harmful effects on the market. Investors often reconsider their holdings in other companies in the same industry when they're faced with bad news concerning one or more companies in that industry. In some cases, the news is sufficiently negative to convince investors to unload industry stock, which can cause prices across an entire sector to tumble. Moreover, news of impropriety at one company may result in panic or public outcry, which usually ends up piquing the interest of government regulators who will investigate industry competitors. Examples of the cockroach theory. The cockroach theory has been used to describe several key events in the financial world, namely the accounting scandals that were discovered after Enron, as well as financial crisis that resulted from the subprime mortgage meltdown. In October 2001, reports emerged that an energy company, Enron, which was upheld as a model of success for U.S. corporations, engaged in deceptive accounting practices, misleading investors and the public for years about the company's financial health. By August of 2002, Enron was in bankruptcy, and the accounting firm responsible for its audits, Arthur Andersen, surrendered its CPA license. The Enron scandal implied that illegal accounting practices may be more widespread than originally believed, and alerted regulators and the investigating public to potential financial misconduct. Over the next 18 months, similar accounting scandals brought down a host of other companies, included WorldCom, Tyco, and Adelphia. In February of 2007, subprime lender New Century Financial Corporation faced liquidity concerns as losses arising from bad loans to defaulting subprime borrowers started to emerge. This company was the first of many other subprime lenders that faced financial problems, contributing to the subprime mortgage meltdown. In other words, the financial problems of one subprime lender, one cockroach, as it were an indication that many other similar businesses were in the same position. Alright guys, I really hope that you liked these spooky season financial articles, because I am loving it. Okay, it's a lot of fun for me. And because it's so much fun, I don't even mind doing it at like 4 in the morning. That said though, in November, from the 15th to the 19th, I shall be in Tampa at the Deja Vu Club for a competition. And then in December, on 8th, 9th, and 10th, I will be at, the Pony East Cape. If you don't know where that is, it's in Illinois, very close to the Missouri border, which is my home state, by the way, and I'm super excited because it means I get to make a little pit stop and see my family while I'm there. But if you're going to be anywhere near, you should stop by and see my shows. And I'll see you next time. Bye! Hi guys, I'm Ginger Wolf, and thank you for making it this far into the video. If you have the time, don't forget to like, comment, share, and subscribe, and I'll see you next time on Stripped Finance. So, in the meantime, I believe in you. I know you can do it. Just keep on grinding, okay?